thank everyone for coming and staying for this, the last session, when there are all kinds of alternative amusements that New York City has to offer. And we'll try to make it worth your while. We're a small group, so there's no reason why you should feel reluctant to interrupt me at any point if you have a question. So, I'm going to actually start by talking a little bit. I last taught empirical market microstructure just this past spring. It's a PhD course that I teach every 2 or 3 years. And market microstructure is not one of these courses that you can teach, and then the next time you teach it again, maybe you have to change 10% of your notes. Rather, it's the kind of thing that every time I teach it, I practically have to rethink what's new, what's old, what's changed, and what's important. And I think one of the things that's changed, and it may strike you as a funny place to begin, but it makes sense because market microstructure has expanded way beyond financial economics, right, narrowly defined. And I'd like to talk a little bit about the clienteles of market microstructure and sort of who's doing the work and what are they trying to do. I'm going to talk a little bit how markets have changed, how that has changed our data, how the theoretical paradigms are changing, and in turn, what that is doing to the empirical tools that we bring to the work, and the questions that we ask. So first, with the clienteles, most of us in this room are probably financial economists, and our classic expertise here is, in theory at least, developing equilibrium models of trading. And these are usually models of asymmetric information, perhaps inventory control. Those are our classic paradigms. But the one thing that we almost strive for, even if we're doing empirical work, we like to keep it in the background that there is some kind of strategic equilibrium going on. And that's the thing that we're trying to characterize. Now, in the United States, most of us are trained as financial economists in market microstructure, but there is another group. It's almost a disjoint group sometimes, and these are the econometricians who deal with high-frequency data, increasingly. And their concerns are a little bit different. It's very good work. They're less concerned, though, with issues of strategic equilibrium and market regulation and organization. And they're more concerned with typically trying to predict volatility or trying to measure realized volatility in the presence of microstructure events. Now, how do you know whether you're in a crowd of financial economists or high-frequency econometricians? If the phrase microstructure noise comes up, you are definitely amongst the high-frequency econometricians. As Ingrid Werner said, you guys call it noise, but to me, it's the signal. And then the third group is the mathematicians. And this is a relatively new group, and I really wasn't aware that it existed, at least in any great numbers, until our math department at NYU started running an annual conference on algorithmic trading. Right? And this past February, when they ran it, there were about 400 people in the room. Now, who are these? Mostly people with mathematical training, fair amount of IT training. They are typically interested in the analysis of high-frequency data by whatever means possible, with the idea of coming up with profitable trading rules. Most of these people are working in the private sector. They could, frankly, care less about equilibrium, strategic or otherwise. And we might be tempted to dismiss them, except that some of the stuff that they're doing is very interesting. Mathematicians have a very broad view about what constitutes interesting empirical techniques. And so we tend to pay attention to what these people are doing. Also, increasingly, they are the market participants. If you wanted to know what was going on in the markets 20 years ago, how trading really worked, what would you do? Well, you'd visit, at least in the United States, a Nasdaq dealer, New York Stock Exchange specialist, or perhaps the block trading desk. Now, if you want to know what's going on, you have to, at some point, talk to some of these mathematicians and find out kind of how they view the world, if they won't tell you exactly what they're doing, which they won't. The other clientele, the fourth clientele, regulators. And I mention this because there are obvious microstructure questions that the regulators should be caring about a lot. Now, in a sense, I thought we were out of the woods on this one, in that most of the academic market microstructure literature was devoted to the analysis and regulation and modeling of equity markets. And when the crash hit in 2000, 2007, 2008, and 2009, those of us in microstructure thought that we were out of the woods. Why? Because the equity markets functioned really well. Unlike 1987, trading did not grind to a halt. It continued, albeit in a volatile process, but it was nevertheless orderly. So all of the things that we were worried about, another market meltdown where people submitted orders and they didn't know whether the orders had been acted upon, or they tried to cancel an order and it turned out the order had already been executed. Stuff like that in 2007, 2008 just didn't happen. So at that point, we were kind of patting ourselves on the back and thinking, well, all this accumulated microstructure wisdom from the 1980s, 90s, and so forth paid off. The markets held up. Then came the events, market break, crash, flash crash, call it what you will, of May 6th, which was very much a microstructure phenomenon. With that, I could say that microstructure issues floated again to the top of the regulatory priorities, at least in the SEC and CFTC. I'm not really sure, though, that we have, unfortunately, I think that in regulatory circles, our influence probably is now lower than it has been at any point since, say, the 1970s, at least in market structure and design. So, what follows next is kind of a then and now. What's changed and how has this changed the empirical analyses that we do? NYSE and Nasdaq used to be dominant. Now, of course, they aren't anymore. Yes, they're still in the game, but they're not the most important players anymore. They're in there, but they are not necessarily the first people you would call on if you wanted to understand markets. Also, the specialists and the dealers used to be very central to the trading process. Even when they weren't directly participating in trades, they were at the nexus of the activity, and they had the bird's eye view, and they understood what was going on. Now, of course, the dominant market paradigm, the electronic limit order book, order-driven markets. Back then, there was automation, but it was in a very limited role. The communications network brought the orders to the market center and transmitted back the news, the acknowledgments. But there wasn't any automatic execution, with the exception of a few minor systems. Now, we have automated executions. Boy, do we have automated executions. And we haven't yet figured out quite how to manage them. Now, this has changed, of course, the paradigms that we use. The classic microstructure paradigms were mostly built along the lines of dealer models, or whether you call them dealers or specialists. And the main effects that people studied within those paradigms were either the inventory control theories or the asymmetric information theories. They both fit very nicely into the dealer paradigm. And that viewpoint led to empirical models of spread decomposition. All right, here's the bid-ask spread. How much is fixed cost? How much is inventory control? How much is asymmetric information? And it also led to the price impact models, where the main driving force would be signed order flow, and we'd look at the eventual impact on prices, for example. The data, well, the state-of-the-art data back then was the Tack data, bid and ask data time-stamped to the second, and it was at the time viewed as being pretty reliable. The most important results, though, theoretical and empirical, followed from that dealer specialist paradigm. There was a very clear, clean separation between agents who demanded liquidity and agents who supplied it, the customers and the dealers. Now, even when we started working with limit order books, we clung to that dichotomy. All right, if somebody is in the limit order book, they are a liquidity supplier, and we can treat them using the same asymmetric information and inventory control paradigms. When you think about it, most of the key empirical constructs here, measures like the effective cost or the price impact of a trade, are very much tied to the perspective of a liquidity demander, the person who's putting in the order. They're the ones that we try to measure the effective cost on, and that's also the event that triggers, all right, the eventual impact on the price. And our data were up to the task of making the distinction. All right, by looking at the data, we were able to pretty cleanly see who was the liquidity maker, who was the taker, who was the dealer, who was the customer, who was the active side, and who was the passive side. So, for example, if you were to look in the Tack data in what I'll call the good old days, and that's maybe, let's say pre-decimalization, all right, we'll call it the 1990s, you would typically see a sequence of events that would look like this. So if you were looking at price over time, you would see a bid and an ask quote, and they wouldn't change very much. Maybe once every 10 seconds, okay, once every 5 seconds in a really volatile market. And then the trades would occur, and typically at the bid or the ask. And on the basis of this, we could confidently sign those trades. We knew what was going on. If we saw somebody lifting the ask, we knew that it was a liquidity supplier being hit by a customer buyer, liquidity demander buying. Now, this is simplifying somewhat, all right? We still did have trades that occurred at the mid-quote, and those we kind of tended to sweep under the carpet or drop from our analysis. But at least if we saw a trade at the bid or the ask, we knew what the direction of the trade was. What you see now, increasingly, are interactions like this, where, yes, there is a bid and ask, and we still see trades at the bid and the ask. But then what are we to make of the following kind of interaction? There will be at some point a gap in the ask, as all of a sudden somebody drops their ask price very dramatically and very aggressively. That can get hit. I'm going to show you some evidence that suggests it can get hit in 1 or 2 milliseconds. Now think about it. By the standard paradigm, the person posting that ask is a liquidity supplier, and the person who is hitting that quote is the liquidity demander. I don't think in this kind of interaction that view makes any sense. It seems pretty clear to me that the aggressor in this trade is very much the seller. And yet, if we take the traditional view, we will get it completely wrong. We'll assign the wrong direction to the trade. Not only that, we will get a different imputation on the effective cost. All right, if we look at the bid-ask midpoint right here, we will infer that this trader was a buyer who slightly overpaid. In fact, viewed in the lights of what we might think is the true prevailing quote, they got a pretty good deal. So it's these kinds of interactions that don't seem to fit very well into the old supplier-demander framework. Another thing that we're wrestling with now is the quality of our data. How many of you who do market microstructure use the Tack data on words? Not a fair number of us. That is still sort of the best commonly available academic data. It's time-stamped to the second. And I guess the problem is we can't have a lot of confidence in those timestamps anymore. They're not really helping us identify in a timely fashion what's going on. For one thing, within a given second, we have many, many quotes, sometimes many trades. And further problem is that even within that second, we're not sure that we can trust the ordering. The Tack data are provided by the consolidated tape system. So they collect quotes from different exchanges. And these different exchanges are subject to different transmission delays. All right, it follows different paths. So we can't really assume even that our data are correctly ordered. Finally, the quotes and trades themselves go through completely different reporting networks. So between the quotes and the trades, we aren't sure if those are sequenced anymore correctly either. Now, I'm going to do more than just complain about the data. I do hope I have some constructive suggestions to make. But first, some of us may say, well, we've been around for a long time. There have always been problems with the data. And there have always been multiple exchanges reporting to the consolidated tape, and we've always had this problem. And that's true, but for a long time we had a luxury. If we weren't sure about the quality of the quotes being posted by alternative markets, we could always concentrate on the primary listing exchange, New York or Nasdaq, and it was plausible, since they were very much the dominant markets, to restrict ourselves to those quotes. We've always had concerns about the sequencing of the trades and quotes. If you go back to the original Lee and Reddy articles, for example, it's often people advocated a 2-second rule, right, lagging the timestamp on the trades to account for delays in reporting of trades. And we could do that, and that was a problem. But back then, the consolidated tape had one thing going for it that was very important, which was that no matter how possibly messed up the data were, we knew that it was still the data set that most practitioners were using. If you were on the trading desk at Credit Suisse, your trade and quote data came from the consolidated feed. All right? You might have other sources besides, but that was your primary source of information about what was going on, say, the floor of the New York Stock Exchange. So Tack defined not only the academic data set, but it also defined a plausible public information set that we could use in our analysis when we were trying to figure out who knew what when.
So question.
Yeah.
So I heard there an industry version of Tack data. Have you ever seen that, or is that
Sure.
true?
If you go to the New York Stock Exchange website, the daily Tack has millisecond timestamps. I believe it actually might at this point have microsecond timestamps. So the stuff that we are working with as academics is just very crude compared to what the practitioners are working with now. This is, by the way, not a tremendous industry secret. It's right there on the website. They sell the data, of course, for something like, I don't know, maybe it's $500 a month or something like that. I mean, it's not a price beyond reckoning. The problem is, of course, still downloading it and working with it. And I don't know about you, but I do not have a team of 10 people who are at my beck and call to download the stuff, sort it, and process it before I can start thinking about how to do econometrics on it. But the problem is, if you look at the desk at Credit Suisse now, they are not relying on the consolidated feed. They are getting direct subscriber feeds from the market centers, bypassing the consolidated thing, and that definitely gives them an advantage, and we can't, as a result, be confident that we know what the public information set is at a given point in time. So how should we measure this theoretically? Well, when I'm going to be very brief about this because this is mainly about empirical market microstructure. But the whole thing that made our asymmetric information and inventory control paradigms possible was this sharp dichotomy between liquidity suppliers and liquidity demanders. If we can't make that break anymore, then we are back in the world of the continuous double auction, which, as any economist will tell you, is impossible to get tractable models for. Now, I don't want to throw up my hands completely here, but there may be some times in the markets where we still might be able to observe simpler kinds of interactions. And these interactions are they're more episodic. They are not sort of unifying theories of how the market works. but they're more descriptions of how trading can occur within certain short, brief interactions. For example, you'll often observe in the data cases where agents are, say, revising their bids upwards, all right, in sequence like that, and at some point they'll stop, all right, they'll have gone as high as they're going to go, and at that point very often we get a trade. Now, an economist viewing this would say, look, this looks like a standard English ascending price open outcry auction. All right? And that's something that auction theory is more developed, and they know how to handle it, both theoretically and empirically. Or you'll often see a case where an agent is seller is progressively lowering their ask price until somebody hits it. That too the economist would recognize in a standard auction model. That's a Dutch descending price auction. Also something that's well understood. So I'm not saying that auction paradigms can be used to provide a unified treatment of how the market works. But in certain epochs, right, from period to period, I think that's what's going on. Oh, before leaving this, the meat and potatoes of empirical market microstructure is the estimation of price impact functions. Now, I made a strong argument suggesting that we cannot trust the signed trades, the signed order flow anymore. And I don't think we can. I think when we say, oh, this is a buy, or oh, this is a sell, we're going to be wrong almost more often than not. Well, what this suggests is that maybe it's time to stop paying attention to the imputed sign of the trade, right? Maybe we should just be looking at absolute volumes and absolute price changes. Now, if this is sounding like the Yakov Amahud illiquidity measure, kind of it is, but not on daily data, all right? High frequency. And whatever merits or problems it might possess at a daily data, I think I can make a pretty strong case for its use on a high frequency basis. Now, there is a bright spot in the data picture in that Nasdaq makes available to us, and other markets do as well, some very good limit order book data. Now, these data consist of messages that are time-stamped to the millit or microsecond, orders that came in, orders that were canceled, executions that occurred. The quality of these data are just absolutely terrific. From this message stream, we can reconstruct the dynamics of the limit order book through the entire day. And as near as I can see, these data are virtually error-free. If there is something weird going on in it, it's almost always traceable to a participant, rather than some kind of error in the recording process. So I'm going to talk a little bit about these data and how we might model them and what kinds of things we might look for. All right, and this is some current work I'm doing with Gideon Saar on Nasdaq's limit order book data. We look at 2007, 2008. I'm going to show you some results based on 2008. Now, the data have some very unusual features that we are not used to seeing in microstructure data. And the question really is just how best to model them. I'm going to show you four kinds of evidence here. One is sort of what do the arrival rates of messages look like? That is, a cancellation just occurred. How long do we have to wait on average until the next thing happens? And then how long after that? So how intense is the message traffic? And that we can analyze using the statistical tools of duration analysis. The other interesting kind of arrival rate that we can look at are the arrival rates of what we call responsive messages. All right? Sometimes messages just come into the market on their own autonomous clock. Other times, they seem to be driven specifically as a reaction to something. Look at that reaction time, and just like a human reaction time, you can characterize sort of what the delay is. I'm going to show you a little bit of evidence about periodicities in the message arrivals. And finally, some very surprising examples of how quickly high-frequency trading can start and how quickly it can stop. So I want to first look at the message arrival rates. And what's this graph? Well, the units here are, on the vertical axis, it's messages per second. So if something has just happened, initially, there is a very, very high chance that there's going to be a follow-on event of some kind or another. So initially, within the first, say, 5 milliseconds or so, there is a very intense likelihood, a very intense arrival rate, something like 1,000 messages a second. But if nothing happens, it decays very quickly. So by the time we are at, say, 1/10 of a second, the arrival rate has fallen off to about 1 per second. All right? So the message intensity falls from around, it's actually around 300 events per second down to under 1 event per second within about 100 milliseconds. Now, 2 lines here. One, the dotted line is for executions. The other is for order submissions and cancellations. And a couple of interesting things here. One is there seem to be some kinds of deterministic peaks. All right? The kind of thing you would get if a computer algorithm were looping over its activity, say coming back to the market 100 times a second or maybe 10 times a second. And you see some evidence of this. All right, now we're used to seeing U-shapes in the data, right? U-shapes in trading volume, U-shapes in the number of trades. We're used to seeing this, and so we're used to seeing graphs like this where maybe this starts at 9:30 in the morning and it ends at 4:30 in the afternoon. All right? These are milliseconds. So the entire graph here covers about 1 second. All right? And what do we see? Well, we see certain peaks in the arrival rates. It's about 60 milliseconds, about 100 milliseconds, and then there are larger peaks at, or other peaks at about half a second and at about 1 second. Now, these, I would submit, are far too rapid to be consistent with any kind of human activity. They're far too regular. So they're certainly indicative of some kind of automated looping here. Now, the next thing I want to show you is that sometimes messages come in at more rapid rates than others. Right? For example, if we were a human trader watching the evolution of the market, there are certain events that might make us react a lot more quickly than other events. All right? One of these events that might be very likely to trigger a response is an improvement in the quote. A bid that goes up or an ask that comes down. That's noteworthy because if we're waiting to do something, the price has just changed and we're likely to react. Or if we are going to react, that's the kind of event that's most likely to trigger us to go ahead and act. Now, one of the races that gets run in a market is this. The bid gets improved dramatically. Now there is going to be a race to hit it. This is not a case where you want to take your time. In one of the previous slides, I showed you a case where the ask came down very dramatically. Now, when the ask does come down that dramatically, you don't want to wait around and think, well, maybe it's going to come down even a little bit lower. All right? They have really closed the gap between the bid and the ask, and if we want to trade, now is a good time to do it. So how long does it take the market to react? There is a definite peak around 2 or 3 milliseconds. And in talking to practitioners, we think that that represents a very sensible estimate of the latency or response time for market practitioners during this time period. And this calls for a little bit different way of viewing things than we traditionally view the evolution of markets. All right? Traditionally, we think that once something has happened, everybody knows about it instantaneously and everybody can react. I don't think that's right in today's markets, if it ever was. When you see a peak like that, this indicates or suggestive of a delay. Not a long delay, but it's telling us something about at least how fast the most rapid participants in the market are able to react. And we think it's around 2 to 3 milliseconds. Now, it's not the only hump in the data. Remember, another kind of interaction that I described for you was a case where, say, somebody would improve the bid, somebody else would step ahead of them, and there'd be kind of an ascending auction. Well, we also see a similar kind of quick response of a resubmission of a quote on the same side of the market. But there's also indications of other participants that maybe are a little bit slower. Now, slow here is relative. Slower, I mean 10 minutes, 10 milliseconds, or 15 milliseconds. A representative human reaction time is around 200 milliseconds. So clearly, we're in the realm of automated trading strategies. Now, we saw earlier in some of these arrival rates indications that messages seem to be bunching up on, say, half-second or 1-second intervals. Here's another way of looking at it. Suppose I look at all of the events that are occurring, and I look at their timestamps in milliseconds. And I just look at the millisecond remainder. I take the timestamp, mod 1000. So the resulting time remainder is going to be an index of where within the second that event occurred. Now, what do we expect? Well, normally, events come in randomly, and even if there's some variation in the arrival process, we'd expect that an event might be equally likely to occur at, say, millisecond 400 versus millisecond, say, 720. In other words, our null hypothesis here is pretty clearly a uniform distribution across the 1,000 integers. In fact, the deviation, the distribution, is markedly non-uniform. You see strong evidence here of messages that tend to come in every second shortly after the 1 second boundary. That's the most dominant feature here, and I can assure you it's regular. We see that in the 2007 sample, the 2008 sample, it's another mark of the computerized trading, as we can envision a computer coming back, looping through the order monitoring and revision process. Now, are there longer cycles? This is what the distribution looks like of remainders mod 10,000. Okay, so think of that x-axis as 10 seconds. That's what it is. And then the question is, where in that 10-second interval do we tend to observe events happen? Again, it's this 1 second periodicity is really striking. Now, if we look closely, we can see other subsidiary periodicities, but this is rather dramatic. Yeah.
You know, when there is that race to a co-improvement,
Yes.
did you find any evidence that that is dependent on the magnitude?
On the magnitude. That's absolutely an excellent question. We haven't looked at that. It's clearly something, and this is one of those things that I think we would want to try and get a bit more sophisticated on. Economists know how to use duration models. It's a pretty standard empirical technique. You can use conditioning information in these duration models. And certainly for an event like this, how aggressive is the movement? It's an excellent suggestion. Now, to set up the next slide, I want to raise the question, okay, these messages are coming in just fast. What does it look like? Can we look at a particular wall clock interval, maybe, and see where some of this activity is occurring? I'm going to show you 3 cases, sort of case studies. This is ticker symbol INWK on June 2nd. This is a 10-minute window from 2 o'clock in the afternoon to 2:10. All right. The blue lines are the number of order submissions and cancellations that occurred. The scale for the blue lines is up to around 120. The red line, dotted line, indicates cumulative executions. I'll come back to the executions, but the main thing I want to point out here is we are used to market activity that kind of ramps up gradually and decays gradually. Not this. This is somebody throwing the switch, and all of a sudden, the number of messages in a 1-second interval jumps from around 2 or 3 up to 120. And then just as quickly, it drops again. You just turn the switch on and turn the switch off. Here's another example. Ticker symbol SANM. Not quite as dramatic, but it still jumps up very clearly at one particular point in time, and then actually later on, after the end of the interval, it stops. Here's another one, GNTX. The message arrival rate goes from around 10 up to around 200. All of a sudden, and then stops, just as abrupt. Now, this, I'll comment a little bit later on what this might be. But one thing I do want to point out is that, and now I'm going to talk about the rate of executions. We're used to thinking about the pace of market activity as everything gets slower or faster, more or less in tandem. That is, some information hits the wire, and all of a sudden there's some more trades, there's some more quote revisions, more cancellations, but everything kind of goes up together. This is a case, all of these three cases, where the order submissions and cancellations just increase phenomenally, dramatically. And yet, there is no commensurate increase in the rate of executions. All right, the red dotted line is the cumulative executions. We plot them cumulatively because if we plotted them individually, they'd be invisible. This line is just easy to see. And yes, there's a very tiny jump here. All right, 5 more executions, maybe 2 or 3 more executions here, but nothing like the 100-fold increase in the quote and trade traffic. So when people talk about high-frequency trading, we're tending to believe that this is maybe something of a misnomer. There sure is a lot of high-frequency stuff going on, but it's not necessarily trading. So, this is empirical market microstructure. How are we going to characterize this behavior? We would like to have nice, concise, summary statistics for telling us how much of this activity is going on in a particular window. I'm sorry, I can't tell you what works, but I am going to tell you what we tried. Now, if you do see this very episodic kind of activity, and you do see this periodic kind of activity in the message traffic. Now, how do you characterize it? Well, this is the received wisdom from the signal processing literature. Think of a cyclic phenomenon, like a musical note, an A flat. All right? Now, we know that that's going to be a sine wave, but in any particular classical composition, that note is not going to be played for the entire length of the composition. All right, it's going to have a start, stop. Now, the received wisdom says if you have something that's cyclical and regular, you use trigonometric, sines and cosines. But if your periodicity, if your signal is episodic, you use wavelets. Now, wavelets come in and out of fashion in econometrics. They have been used a little bit, I think, to model volatility, sometimes consumption-income relationships. They are certainly not our common toolbox, but I think here they might have an application. I tried baby wavelet analysis, the kind of stuff you can do in SAS with your proc wavelet. And the simple things didn't seem to help us very much, except that they did lead us to these examples. That is, when we saw something weird going on in the wavelet patterns, and we looked back at the data, it often caught something weird going on in the data. So we haven't given up hope yet for this approach. Now, so there's a whole lot of activity going on. What exactly are these people doing? Do these, when we look at the submissions and cancellations, do they correspond to any kind of recognizable strategy? I'm just going to show you again a couple of examples. This is a sequence of events. It was roughly over about 30 seconds. There was a submission of a limit order to buy 100 shares, followed within about 11 milliseconds by a submission of an order to buy 300 shares. Now, very shortly after that, within a few seconds, that 300 share order was canceled. And then it was quickly, within 1 millisecond, resubmitted. They repriced the order. Except they didn't. They just flashed the order and then took it back. Now, market microstructure, at this stage of looking at the data, we really have to use our imaginations. This is not econometrics yet, although I hope it will be. And then we see successive, what happens next. That 100 share buy order gets canceled, and within the same millisecond, there's another submission, although this one is at a higher price. Right? And then this goes on for about 100 more messages with this interplay of the 300 shares being submitted and canceled, the 100 shares being submitted and canceled. And it is, when we first started doing this, we thought that it was going to be very easy to identify strategies and look at a record like this and be able to impute clearly what was going on. I don't think we can. This is one that involves two participants. Here's one that just involves one participant of submitting, canceling, submitting, canceling, submitting, and canceling, all for the same 100 shares. And this activity, right, and the submissions and cancellations occur at intervals of about a few milliseconds. This is not something that's occurring deep in the book, all right? The submissions and cancellations of these orders are changing this market's ask price. They're causing it to fluctuate very rapidly. Right? So, and we have other examples of sequences like this. In one case, there was a sequence of about 83,000 messages within a space of about 3 minutes, running the quote up and down again, up and down again. This defies my imaginative powers to impute some kind of strategy to it, but it is real. Now, when we see things like that in the data, one of the things that we would like to impute is this some kind of coherent strategy? Well, leave off coherent for a moment. Let's just ask, is it one agent? All right, who is sending them in? Now, at this point, we need to be a little bit algorithmic ourselves. First, on most limit order systems, you can track a limit order in the following sense. You can see if the order gets executed or if it gets canceled. What you usually cannot do is link a cancellation with a subsequent resubmission. All right, because we don't identify the customers here. But we think you can get an awful lot of mileage, and this is going to lead to tremendous insights about strategy, because we think that you can get a lot of mileage by imputing links. Okay, there's a cancellation. Now, within 1 second, is there a resubmission in the same direction for the same quantity? The answer is yes. We think we have the same play. And once you construct runs like this, you can draw some conclusions about the markets that you couldn't otherwise draw. First, there are an awful lot of cancellations. The majority can be linked to a subsequent resubmission. Not only that, okay, Joel, fine, you get a cancellation and sometime later a submission. How do you know they're really linked? Well, in most cases, although we allow for a second, most of the time that resubmission occurs within 1 millisecond. Another interesting thing is that of these chain sequences, about 18% end in a passive execution. And that's interesting because if you've looked at limit order data, the fill rates for limit orders are, if you look at the individual limit order, they're very low. 1%, 2%, and you wonder why people bother. But then you realize that if you look at the whole chain, the chances are that you'll get an execution, 18%, these are a lot more respectable, which makes these sensible order submission strategies. Another interesting thing, what happens when we look at a case where there's a bid and an offer, and one of those is hit, all right? There's an active execution. Somebody hits one side of the market. It turns out that 24% of the time, when we look back, that active execution was preceded by an attempt to get a passive execution. And this corresponds to what we think of as the canonical limit order strategy, right? You start away and then make your price more aggressive, and then if you're not getting any action, then you throw up your hands and say, okay, I'm going to throw in a market order. And the important implications of this for how we think about markets goes back to one of the first points that I made, which is that we can no longer trust the clean dichotomy between liquidity suppliers and liquidity demanders. We're seeing this in this one statistic. 24% of the liquidity demanders, so to speak, were very shortly before that liquidity suppliers. So the dealer-customer distinction, it's a lot more fluid now than it's ever been. And this is going to cause changes in how we model the dynamics of prices and trades going forward. By the way, if you ask, well, how does this activity affect the market quality? We think it's beneficial. At that point, I expect to be argued. Now, there are two things I want to briefly comment on. Actually, I'm going to skip the Gibbs samplers, but I do want to talk a little bit about liquidity risk. One of the things that has always sort of justified interest in market microstructure is the possibility for insights in asset pricing and asset pricing and corporate finance. In asset pricing, it's liquidity risk. Now, liquidity risk has been incorporated into asset pricing models. If you talk to practitioners, we're pretty sure that it's there. They worry about it. When they get into a position, they worry that they won't be able to get out. So it's real. But I think there are tremendous opportunities here in figuring out how to measure it. It's not a simple thing to measure, because what practitioners worry about is not liquidity risk in the sense of, oh, the spread is going to be 3 pennies wider than it is normally. They worry about catastrophic liquidity failures, the kind of thing where the market effectively shuts down. That is where I think market microstructure might have something to say on how you predict these extreme illiquidity events and how they should be priced. Okay, this is very subjective sort of overview of what I think is going on and important. This is not covering the waterfront by any chance. I take a very broad view of what constitutes market microstructure. In fact, I think of macroeconomics as long horizon market microstructure.